Hello, everyone, and thank you so much for joining the Online Chapters Education Committee Open Forum. We hold these events every odd month on the third Wednesday. The Online Chapter Education Committee members are Sriram Matabushi, Dan Perlman, Phil Suter, and I'm Chris McCarron. Before we get started, I want to give you our standard disclosure. We are recording this session, so if you're on the lam or if you're on witness protection, please keep your camera off. Otherwise, we would love it if you would keep your camera on. And depending on your questions, it's very likely that we're going to talk about a specific stock or maybe a product that is not endorsed by BI. So just know that all the information that we share tonight is the opinion of the Education Committee members and not specifically the opinion of BI. And as you know, we're not trying to give you investment advice, and we don't suggest that you run out and buy any of the stocks that we talk about. If you hear something that sounds interesting, then go do your own research, because that's what BI is all about. Also, you have the option with Zoom to have closed captioning. If you would like to watch us talk as best it can translate us, then you can just turn that on yourself. I think you just go down to the bottom of your screen and you can just have the option of your caption settings. And you can even choose your language. And now I'm going to turn it over to Education Committee member Dan Perlman, who's going to introduce our special guest for today. Dan.
Thank you, Chris. It's my pleasure to introduce tonight's speaker, Craig Braemer. Craig is one of my favorite better investing educators. If you're looking for a method for investing in high quality stocks that provide both capital growth and a steady dividend income flow, Craig's approach is for you. Craig has been a Better Investing member for over 30 years. At the local club level, as well as at the national level, he has supported BI's mission of educating people from all walks of life in learning to become successful lifelong investors. Nevertheless, he himself is a financial professional. He has a BS in accounting and a master's degree in financial services. After his university education, he obtained certification as a financial planner and as a chartered financial analyst. Craig has worked for Merrill Lynch, Franklin Templeton, and for almost 24 years for Highmark Capital Management, a subdivision of Union Bank. At Highmark, he became a growth fund portfolio manager and ran what he called a relative dividend yield investment strategy for both institutional and high net worth clients. Today, I think, and maybe I should check it, he's quote retired, but still doing financial advising as a portfolio manager and principal in a San Francisco area wealth management group. We feel very privileged and delighted to have Craig with us tonight. So we will now turn over the mic to him for his talk, followed by a question and answer period with him, and then end with an open forum. So Craig, please take over now.
Thank you so much, Dan. Hopefully you guys can hear me okay. And thank you for the kind words. My background, I am semi-retired is how I look at it. I still work about 40 hours or more a week, but I get to choose how I want to work and when I want to work. So to me, that's a blessing. I did turn off my video so you can't see my lively face talking all the time, primarily because I have bandwidth issues on occasion here. So that saves a little bit on the bandwidth. So my topic for tonight is the case for stocks with growing dividends. Hopefully everyone can see that on their screen, and hopefully you can hear me okay. As mentioned, I am part of the San Francisco chapter. I've been involved with it since the 90s, and I've taught a number of different classes, and I do have a bunch of gobbledygook letters after my name, so I've been doing this for a long time. This topic is quite important to me. This is it came out of a very close friend of mine's investment process that he was doing when I met him about 10 years ago, 12 years ago. And I quickly thought it was, you know, very straightforward, but very easy to understand and think about the strategy. And then the concept made a lot more sense. And it's obviously been pushed forward by firms like Vanguard and others. But you know, this is a concept that I like quite a bit. And as mentioned, when I meet with clients, many of my clients, most of our clients will end up using this strategy because I think it fits in so many individual cases. But my buddy Phil was the person who really kind of showed me his thought process of how to think about it, how to do it, and I've followed it ever since. As mentioned, I was involved with a relative dividend yield strategy, which was somewhat similar, but not the same. It didn't focus on number of years of dividend growth. And that's the big difference between that. But I have been working on various dividend strategies for about 30 years. With that, let's disclaimer. You've already heard one disclaimer. I'm going to just talk about a bunch of stocks, services, and other things. They are all for educational purpose only. I'm not recommending anything here. And this class is being taped. This is what I'm going to cover. A lot of my presentations, if you've ever seen me in the past, I like to tell you why you should be listening to me. I think this is the first one is the most important of why you should be listening to this. I think this is actually a strategy or a concept that anyone can do. Everyone probably should do at some level, and it's proven to be competitive over the decades. We'll cover a few dividend basics. We'll talk about some dividends in your stock selection guide. And then we'll talk about the strategy that my buddy Phil talked about, and I actually use today and have been using now for about 7 years. Bottom, I personally think growing dividends are great. I love finding companies, and there's nothing better when I, go look at my account, whether it's daily or weekly or monthly, and I'll go through the statement. I see all these dividends coming in every month, and I didn't have to do anything other than own that stock. That's a good feeling to have. And so I do appreciate that. So this is why you should want to consider dividend growing stocks. And this chart goes back to 1973. It was put together by, I believe, Ned Davis in conjunction with Washington Crossing. And the dark blue line at the top shows dividend growers and initiators, meaning that they just started paying a dividend. And and I've circled a number of different types of strategies at the very top, and they would consist of dividend growers at the very, very top, followed by all dividend payers, followed by the S&P 500, and then unchanged dividends. In the bottom, in the red circles, you have two groups. One were dividend cutters at the very bottom, so you definitely have to worry about these quite a bit. And the one right above that in the kind of a light tan, yellowish color are dividend non-payers. Now, one part of my career, non-dividend payers were the way many investors were thinking it was the way to go. This was in the late 90s when everything was going up and dividends were kind of considered passe. And many people thought, well, you don't really need to worry about dividend stocks. Well, that quickly changed. And you can see after the 90s, non-dividend payers struggled mightily, and they've had a hard time coming back. It doesn't mean they can't still make money for you. Obviously, owning Google has been a pretty decent investment over the decade or two, but it just says you're not getting part of that total return that you want to get. But the top half looks at dividend payers, and the one on the top is dividend growers and initiators, which when I saw this chart, I became very much more interested in this concept of just owning, not just owning dividend payers, but just owning dividend companies that actually increase their dividends on a consistent basis. So let's look at this at another angle. And this is looking at it from both return, but now risk. In this particular case, again, from the same database that did that chart, the same group came up with this one. And I'm going to point out two of these. Dividend cutters, again, I said, be careful of these. These are dangerous to your financial wealth. You want to be careful on these, and you want to try to avoid them. Not only are they the worst returns on all the different options on this page, it also has the highest volatility or annualized risk. some people would disagree that that's what risk is really, but it is volatility at the end of the day. And so you tend to have more downside and in the same time, a lot of more volatility in your stock price. Comparing that to the one right below it, which is dividend growers initiators, which is the best return over that time frame. It also has the lowest volatility over time. And so this combination is a very nice combination. As an investor, you would think you'd want to have one of the higher returns and one of the ones that have a lot less volatility. It's something that allows you to maybe sleep at night, so to speak. But so this is the reason why I became very much more interested in dividend growers over the last 20 years. And then lastly, I want to show you this next slide, which is exactly the same slide as this slide, just shows in a different manner. And I actually like this the best way. And the reason I like it, because it's just very simple, quickie, and I can look at it in a second and go, got it. I want to focus on the green box up to the upper left. They all have lower risk than the box in the red, and all these guys have annualized returns higher than the people in the red. So for me, this was the one I actually liked the most, but I show both of them because I know people learn different ways. And again, it does show that companies that have dividends over this time frame, and again, this is only 50 plus years. So it's, in the world of research, it has some efficacy, but it doesn't have, you don't have 100 years of data here, but you do have a pretty good database that many people would consider pretty solid to, make some assumptions on over time. So the one question that I usually will get, well, what does it mean to be a dividend grower and initiator? So what it's doing is every year it's measuring, did you grow your dividend this year versus the last year, or did you initiate a dividend? And if you were kept in this universe, and they were measuring returns accordingly. There's a bunch of other statistics on how they put this study together, but that's kind of the broad-based process to think about. I put it together, just some quick assumptions that I got out of this, or conclusions, I should say. Summary debt points. Dividend paying stocks or companies seem to win versus non-payers over long time periods. Dividend paying stocks are usually less volatile. I think that's pretty intuitive when you think about it, because you're getting paid some income throughout that whole time frame versus the company that doesn't pay you anything, that you would think would have a little bit less volatility over time. Be careful of stocks that cut their dividend. We'll spend a little bit more on that in a few minutes. And then finally, dividend paying companies seem to have strong shareholder focus and solid financial history. And I sum that at the bottom, saying growth, profitability, and commitment to shareholders are good investor concepts to be focused on, both at the company level, but also as an investor level. And clearly I spend my time these days looking for companies that are willing to not only grow, they can be profitable, and they're willing to share some of that commitment to shareholders by giving me a dividend. So I promise you, it's spend a second looking at dividend cuts and why they are dangerous to your financial wealth. In this particular case, my buddy had one very highly sophisticated rule of how did he deal with companies that might cut their dividend or not raise their dividend. And this very sophisticated rule was so simple. I asked him 3 times when he first explained. I said, really? That's it? He goes, that's it. I said, oh, okay. So as you can see on the upper chart here on the left, you can see in the little green arrows, 14%, 50 some odd percent, 10%. That shows the dividend growth year over year for a number of years. And then you can see this 0, meaning they didn't grow the dividend. And so this is the dividend chart for the last 8 years of this particular stock, and this stock is called Core Labs. And so in his world, he had a very simple, very complicated rule. You don't raise that dividend, you sell the stock. No questions asked, no discussion, not, oh, we should do some more analysis on it. It was sell the stock. Why? He owns a dividend growth strategy. He wants to own dividend growing companies. If you're not growing your dividend, he doesn't want to be in your portfolio. And then the second reason for that was, if your company is growing its dividends, very rarely do you go from raising your dividends consistently to all of a sudden cutting your dividends. Now, some of that's changed in the last year or two, and you'll hear about this occasionally, called variable dividend companies, where their dividends will go up or go down depending on the company's earnings. We'll have to wait and see how that gets received by investors in the long run. I don't really know. It's too soon to really tell whether that's really going to take off. Investors are going to really like that or not. We'll see. But his rule is very simple. You don't raise a dividend, you cut it. So that would be, in this case, 2016. And so I put this little line on the chart, stock chart, to show you where that would have been when the beginning of the year, you would have then realized that they did not raise that dividend at any point in time in the last 12 months. And you would then at the time to look to sell. So you can see then after that for 2016, 2017, 2018, you could have sold this stock someplace between 100 to 120. And so this line just marks you where you were on the chart roughly when you would have realized that the company had not increased its dividend. Put this red arrow on the far side because a red line, I should say, as also this stock went into a slide in late 2019, in late 2018, going through 2020. This is when oil prices got crushed at one point in time, and many at that point for a whole bunch of different reasons, and this company in particular also got crushed in this particular case. Now, I circled right here because in 2020 they decided to cut the dividend, and they cut it by 54%. Well, you can see that on January 24 of 2020. Well, that's probably all. The stock has already gone down quite a bit by this point in time. But just a perception that the company could cut the dividend is why the stock gets hurt. And again, my buddy's rule was so complicated. It was simple is, oh, you don't raise that dividend? I'm selling that stock out now. I'm not waiting. Because again, most companies don't go from raising their dividends to cutting their dividends the next year. That's not very common occurrence out there. So in doing so, by getting out sometime in 2016, 2017, you pick the time frame of when it would have been, you would have gotten out around $100 to $120 versus some point there after they cut the dividend, someplace in this $20 to $30 range. And, and then again, in October of that same year, they cut the dividend a second time, and it cut it another 96%. Anyways, what you can see is this stock was a $100+ stock. One point it was a $200 stock, but a $100 stock that's now in the $20 range, or was in the $20 range. And thus, as I say earlier, these are dangerous to your financial wealth. You need to be very careful with dividend cutters. And I thought his process of if you're not raising it, it's gone, was a very simple concept, but it works very well. So let me touch on some basic concepts. I'm going to cover some things I don't cover as much in this section as I would normally touch on when I'm teaching a full class. But the concept of a dividend is just simply, it's a portion of the company's earnings paid to shareholders. That's all it is. Again, higher dividend yielding stocks will probably have a slower growth rate. Growing dividend stocks can start with a very low yield. They could be 0.5% or less. But if you're growing it each year at 5%, 10%, 20%, it can be very meaningful in a fairly short period of time. All sizes of stocks can pay dividends. I have a small company that I don't think even generates $100 million in sales, and they've been paying dividends for years. Being that you're always trying to own companies that are increasing their dividend, you have a relatively consistent, predictable income stream that probably grows over time. And then lastly, we're back in this inflationary environment today that we haven't seen since probably the 70s. And what we learned in the 70s was dividend growing stocks actually, and small stocks actually did relatively well against inflation. And so I would argue that should help regarding some inflation, because you're getting an annual boost to that dividend income stream. And then finally, you also, because you're getting some income stream, it should give you a little bit lower volatility, as I showed you in the chart. My belief is very simple at the very bottom here. If you can get a growing dividend and an appreciating stock price, you win in many different ways, in two different ways. I love seeing this on a daily basis. I love to have a nice growing dividend stream. And just to be able to see that over time is a very positive thing for me. Again, some more dividend basics. Dividends are declared at the discretion of your board of directors, your BOD. They do this typically quarterly. Not all companies pay dividends on a quarter. Some only pay annually. Some pay semi-annually. International companies tend to pay either annually or semi-annually. Board of directors take into account the business activity, what's going on around them on a regular basis, and the capital needs of that business to determine the dividend amount. Historical payouts and dividend increases are big considerations for the board of directors. Remember that chart of Core Labs and the dividend cut. Cutting your dividend is painful to the company as well as to your financial wealth. So they take it very seriously. It's not something they typically want to do. Then finally, cash flow statements can be very useful with dividends. I typically go there first for most companies, and then follow up on the balance sheet would be next. Why doesn't everyone pay a dividend? If it's such a great thing, Craig, come on, everyone should be. Well, true. I would think most companies should. I regularly will if I'm talking to a management team from a company, if I think they should be paying a dividend, I'll tell them so. There's lots of companies I run across. I go, well, why aren't you paying a dividend? And sometimes they have a good reason. Most times I don't think they really do. But I think most companies should be paying a dividend. It's a good process for the company to figure out how they grow their business and allocate some money to the investors that have allowed them to do what they do. But many fast-growing companies, younger fast-growing companies, they have better growth opportunities. They really should be putting the money back in the business. When I went to college back in the dark ages when dinosaurs roamed the earth, we were taught three things. If you're a young business, put the money back in the business. If you don't have any opportunities in your business to grow, go acquire something. If you can't do one of those two things, well, then I guess you pay a dividend. That was back in the 80s. That I still believe is true for many younger companies. But having said that, I've run across companies like a Southwest airline who operates in a very difficult industry, yet they pay dividends for years while no one else in the industry paid dividends. Why were they able to do that and nobody else? Were they a better management team? Did they have a better model? They're still flying airplanes, not terribly different than the next guy, but at the end of the day, they were, I think, a better operated company. Other reasons why you don't do it, you don't pay a dividend, you don't generate steady enough cash flow. Again, you don't want to raise your dividend or have a dividend and have to cut it. If you have too much debt, or if you're highly cyclical industry, if you're very cyclical year after year, then it's one of those things you probably don't want to deal with. And as I said already, if you're already paying it and you have to cut it, then more likely than not, that's not a good thing for your stock price. The key ratio in the dividend world, outside of what we normally would look at from better investing stocks, is the payout ratio. And the payout ratio is defined at the very top here, is dividends divided by earnings per share. It's a ratio that's easily comparable to any other company out there. And it gives you a nice ability to understand what the future might be in regards to sustainability of that dividend and the growth of that dividend. Having a lower payout ratio allows dividends to help continue to grow for a lot longer time horizon. Be careful on high payout ratios. Once you get in the 50 to 60% range, when you get past that, you have an issue. Hang on a second. I just did this yesterday. Not sure why it's doing that, but it's doing that. 50 to 60% payout ratios seems to me very reasonable. It's at the very high end though. Once you get past this range, or when you start getting into this range, the growth rate's going to slow on that dividend growth on a consistent basis. So just be aware of that. Now, I wanted to spend a second and just talk about how dividends can go up. This is a picture of two companies, Kohl's and Apple. Both started dividends back, one in 2011, one in 2012. And this is a picture from a value line. I circled the capital structure of the company for each one of them, so you can see they're a little bit different from each other. There's actually a little bit more on a percentage basis under Kohl's than Apple. But what you can see when you go down to all dividends to net profit, which is Violine's definition of payout ratio. It's a long way of saying payout ratio, is that when they first started paying a dividend, it was 23% of its was his payout ratio. So 23% of its earnings were being shared with investors. And that quickly got up to 58, 60%, which is, again, what did I just say? When you get to that level, that becomes somewhat more of an issue. Now, personally, they could probably sustain it, depends on the company, for a long period of time and still grow those dividend streams. But when you start getting up at a higher level, it becomes a little more difficult. Apple, on the other hand, again, all dividends to net profit, your payout ratio, when they first started paying, it was only 6%. They were quickly raising that dividend, and even though they've raised it quite a bit over this time horizon, it still only got to 24% payout ratio. So still pretty low, still very far away from that 60% number that I worry about. So again, look at each company. You can see this in the value line. It's very simple. You can see how that payout ratio is changing over time. Companies tend to get to a certain type of a payout range, and they tend to stay in that range, either on purpose or just by happenstance, and they tend to follow that pretty religiously. So financial statement analysis, when you are out there looking, watch out for companies that add debt to pay for the dividend. This is actually very hard to find. I mean, it's easy to say, hard to find. You can sometimes see it in the cash flow statements when they do them. The question is, okay, is 1 quarter a bad thing? I wouldn't say 1 quarter is usually too bad, but if you're supporting that dividend with debt over a year or so, I would become very concerned whether they can keep on doing that unless you already see that business turning around quickly. If you want a growing dividend, keep the debt low. It allows you to keep paying that dividend, even though the business might not be doing so great in any one particular year. BetterInvesitng talks about keeping your percent debt to total capital, or to capital, I should say, of not more than 33%. This gives the company flexibility over the lean years to continue paying a dividend, even though cash flow might not be completely at the level they need on that particular year. Lastly, some industries, utilities, REITs, and the defense industry normally carry a much higher debt load in the 70s, 80s, or even higher. And the payout ratio typically is higher as well. They don't have nearly as much growth. Some of them are regulated, and they'll also typically pay a higher dividend yield. But so those three I would exclude from my rule of 50, 60% payout ratios. But, so just be aware when you see a REIT and it says an 80, 90% payout ratio, it doesn't mean it's going out of business. It's just, that's the way those things operate. Now, dividend stocks and your stock selection guide. Personally, I keep using my stock selection guide to find me growing companies. That's what I'm looking for. I also believe in the mantra that we share over time, that stock prices tend to be led by growing earnings, and usually growing earnings can also lead into growing dividend streams. So those all three tend to be somewhat connected over time. Portions of your SSG focuses on the dividend, and I'll touch on a couple of those here in the next page or two. Payout ratio, again, is a key metric you want to use, and I've said it 2 times I think already. Having a low payout ratio with an attractive stock selection guide is potentially a way to find a good winning stock over a long period of time. So in this particular slide on section 1 of your SSG, I have this green line in here, and I have it in here, and this represents dividends. So simply in your SSG Plus, you can click on dividends. You can put that line on your screen so you can see how is it doing. I would guess more times than not, it should be doing this, going up and to the right, like your sales and hopefully your earnings and pre-tax profit. You can also find dividends in section 3. And this is actually a very good place to go do a lot of work. And I spend a lot of time in this particular section looking at the dividend growth over time. And what I said earlier was not only get dividends growing plus stock price appreciation, this is the best place to go see all that happening. And it's pretty powerful. So in this case, we have 2 different stocks. On the top, I have a green box and a red box. Let's spend some time with the green box first. And on the one on the top, we can see I like looking at the low price and see if the low price has grown over time. In this particular case, the low price has gone from just under 30 to a little over 60. So it's basically doubled. That's nice to see. In column C, I see the earnings per share. They've also just slightly more than doubled as well, going from $2 to $4.26. Now see then you go to the red box in column F, and you can see the dividends have gone from 35 cents to 86 cents. So they've more than doubled. So not only did my stock price go up, I also am getting a larger cash flow stream today than I was 5 years prior to this. And the beauty about this is in column G, the payout ratio. Payout ratio went up, but it only went up from 17% of earnings to 20% of earnings, even though your dividends more than doubled. That's very, very powerful. That means you have a chance of having that income stream continue to grow for long periods of time. So that's one company. So let's look and compare it to another company. This particular company, its low price also went up, but not nearly as much. It went from 19 to 28. Its earnings went from just under 2. It was 260, but then last year it really dropped off to 146. So that would require you to go figure out what's going on there. And in the red box, dividends also grew from 83 cents. It almost doubled during this time horizon. But because the earnings fell off, their payout ratio in that last year was just a little over 100%, meaning that every dollar of earnings you had, it was all going to paying the dividend. You're putting nothing back into the business that particular year. So that would be a concern, and you'd want to understand why did the earnings drop off so much over here in column C. But this is how you see and can see dividends in your stock selection guide. So I've covered a variety of different topics. Let me just stop and see if there's any questions before I go and touch on the rest of the stuff. Any questions out there? Not hearing any questions? Then we will continue on.
Craig, let me just pop in here one sec real quickly.
Okay.
If people have questions, there's two things you can do. You can save them until Craig asks you if you'd like a question, but the other thing you can do is you can put your questions in the chat, and either Craig or one of the team members will address the question. Thanks.
So a question just did come in, Craig, that somebody was asking, where do you actually look for stocks like this?
Where would you look for stocks like this? Same place you look all over the place, but I'll give you some research ideas near the end of this presentation. But you can, in our stock selection guide, there is the magnifying glass that allows you to do screening, and in there's a dividend screen in there. If you've not found it, you should go look at that. But there's many ways you can go out there and look for companies that grow their dividends. We'll touch on that in a couple of seconds.
Hey, Craig, I have a question.
Sure.
So you're comparing a few slides back, Kohl's versus Apple. But if you look at the price from 2011 to 2022 or whatever, if you compare, the stock price barely changed for Kohl's. It's about $50 to $60, I believe.
Mm-hmm.
Whereas the stock price for Apple went from probably less than $20 to almost $150.
Sure. And your point?
My point is the stock price, is it not countering the dividend?
Is it not what?
Countering the profit from the dividends.
Countering the profits from the dividends. I guess I look at it differently. I would much rather own that Apple stock with a payout ratio of 25% after 7 years of raising its dividend, and take the price appreciation plus the dividend growth over that time to give me a much better total return than I would have received from Kohl's.
Exactly. Okay. Yeah. And yes, in other words, the difference in price appreciation will reflect only when you actually sell the stock.
Correct.
Whereas in case of calls, even though you're not selling it, you're still earning at a higher rate.
Well, you're getting a higher payout ratio. I didn't
Yeah,
give you
payout
the
rate.
I didn't give you the dividend yield, so that you can't make an assumption there that you're getting a higher return. So
True,
I
true.
won't agree with that. But you are getting a higher payout ratio, which means that your business probably doesn't grow as fast as that other company that you're looking at. And then you have to make the decision, which one would you like to own more of? Personally, I'm not a big fan of retailers because I see no really strategic advantage of most of them. So how do you stay competitive over the long period? And, you know, but yes,
Yep, thank you.
sure. Anything else? Otherwise, I'll dive on to more.
Just a quick couple comments. Somebody had said that you can use some of the screens, such as like Schwab, for dividend screening or increasing dividends. And you've all, I guess, just made the comment that utilizing this strategy for companies like Disney, which apparently is suspended dividends, it would, raise the red flag and knock them out of the consideration, correct?
Yes. Dividends, Disney is actually kind of unique. So in 2020, obviously the world stopped. Companies stopped doing lots of things they normally would do. And Disney in particular had almost every single one of its major businesses shut down. Its movie business wasn't happening because people can't go to theaters. Their park business was closed down. And so everything where they would make money, they couldn't make money. So my buddy Phil and myself both concluded in 2020 that we would have an exclusion for that year and companies would have to reinstate that dividend. But for those companies, number one, we'd go back and relook at the business model and decide if we still want to keep those companies or not, even though they did cut their dividend to zero because of the uniqueness of COVID. It was the only time in his 20 some odd years that he'd ever done this. To me, it made sense to go do that. I had 3 stocks or 4 stocks that cut its dividend. One of them, Cracker Barrel, I decided to sell because I was just concerned in the long run on as its overall long-term business model. It's still a fine company. I just didn't think the business model was going to be as attractive. I thought it was going to be just tougher to get people to work, which means you just have a higher cost structure. So we sold that. I sold that one. I kept TJX because I thought that they would come through this okay. They reinstated its dividends less than a year later. And Disney was the last one. And I actually waited. The rule was we wanted to get them back into a normal economic environment for their business. And in the last 12 months, I felt they were back to a more normal economic environment for their business, and they still haven't put their dividend back. So I actually just sold that stock because of the fact they aren't paying the dividend. Again, it's a dividend growth strategy. I want dividend payers, even though I like Disney and I like Disney for the long run. In this strategy, it doesn't fit. So in that particular case, I did actually sell Disney just recently, but I actually like the business for the long run. It's just they don't pay a dividend. Does that help?
Yep, perfect. And last, I guess, Sarah asked the question of, do you know offhand what % of all companies pay dividends as far as identifying the scope of how many different companies?
That's a good question. I don't actually know off the top of my head how many companies pay dividends. I want to say it's 60+%, but I don't know off the top of my head.
Yeah. Okay, thanks.
Sure. Though I will have some slides a little bit later that might help answer some of that, I think. Here's one of them, not really that particular answer, but total return, which is the combination of capital appreciation and your dividend yield over time, that contribution to total return goes up or goes down based on the decades. The roaring 90s, dividend yield only as its portion of total return was less than 16%. Why? Stocks did really well. You had all this price appreciation. Whereas back in the 70s, it was almost 73% of your total return all came from dividends. But over time, 1/3 of your total return has come from dividends, from companies paying dividends. So this is a pretty important piece and something I think most investors should probably be paying a little more attention to when they think total return. Yes, we all want to buy the stock that will go from here to kingdom come. Trust me, that's what we're all looking for. But this might help you have a more stable portfolio over time. This, again, doesn't answer the question was asked, but it does show you what the dividend growth rate. And over long time periods, it's going to be someplace between 5 and 10%. But you can see the impacts of a financial catastrophe like 2008, 2009, where you had significant number of dividend cuts in 2009. And in 2008 and 2010, you only had very low dividend growth rates. Companies were trying to deal with the recession back then. And so, and that was basically a more common recession than the COVID events of 2020. So not exactly the same, but pretty close. But you can see over time that what happens if companies are paying dividends, they grow, and something for you to think about. So my buddy's dividend growth strategy, or even the one that I'm running today, this strategy is focused on investing in high quality companies that happen to be paying dividends. So again, you can do a lot of your stock selection guide, but in this case, I'm looking for companies that are dividend paying, and I want them to be meaningfully growing those dividends over time. So the one key to this strategy, so there's a couple of different major keys. One was if you don't raise a dividend, you don't keep the stock. Second one was you look for companies that have been able to grow their dividends for 10 years or more. Why 10 years? It's a bit arbitrary, but after doing enough looking and researching over time, there's the dividend aristocrats that say you have to grow dividends for 25 plus years. It just seems like you're giving up a lot of potential growth from years 10 to 25 where you could capture that. I believe it's long enough to show that the companies have a commitment to the dividend, but you're not giving up all that growth for 25 years where you might be able to capture that as an investor. Number two, the yields can be low. A lot of my yields in the portfolio will be less than 1%, but they're growing and usually growing at a pretty good clip. And that's something that I like to go see. Finally, the payout ratio, again, is pretty important. I try to keep it under 50% for most of the companies. There'll be a few. We got a couple, we have a defense company in the portfolio. We got some slower growing companies. So we'll be a little closer to 60 in a couple cases, but as a whole, once you start getting past that, I become quite nervous and don't want to be there. If there's no growth, you've heard this 14 times, I think by now, over a 12-month period, we sell. 2020 was a very unique time period. So we did have an exclusion period at that point. Again, dividend growth strategies and other rules. I mean, I don't think it's dramatically different than how most of us think about trying to find stocks on our stock selection guide. But we're trying to find solid growth companies. And what we want to focus on in that quality is, why does it have that quality? Why does it look great in a section 2? Well, if it has a unique characteristic or a strong economic moat, a wide economic moat, I should say, about their company that gives them an advantage. Do they have #1 market share? Do they have low cost advantage? These are key and very important and should show up in the numbers over time. Look for positive and strong cash flow. Again, you can chart cash flow on section 1 of your SSG in the charting function. Concern over cyclical nature. I worry all the time about companies that are too cyclical, and I try to minimize those as best as I can over long time periods. Strong financial strength, as I've shared earlier, will help you continuing paying dividends during some of the leaner time periods. And if you start with a low debt to capital ratio, that gives you even more flexibility. Again, or if I haven't said it already, this is not a high dividend yield strategy. I am not trying to pick up 4, 5, 6% yielders and hope they're going to keep on paying that dividend. That is not what we're trying to do here. We're trying to get actual growth and with the capability of trying to compete with the markets over time. Be careful of poor business models. You can see that in section 1 and section 2 of our SSGs. If those don't look great, well, it's probably not a great business model. Do you really want to be there? And then finally, I think the SSG is a very good tool for helping you find good business models. Section 2 allows you to see the profitability of those companies and the things that go along with that. And I would prefer owning companies that are much more profitable over time than others. Again, if the company doesn't raise its dividend, we sell. There's not a lot of discussion. It was suspended during COVID, and we'd go back and do more research. I gave you the history of what we did there. Kept one, I kept two, eventually sold one of those, and we sold one right at the very beginning. We didn't even wait around. We just said, we don't want to be in this business model. Other reasons to sell. Let's go back to our standard stock selection guide rules, guys. You know, does it have a high, you know, is it overvalued significantly? Does it have a payout ratio that's getting way too high? Is its position size in your portfolio too large? Maybe you need to trim some. Or the dividend growth is growing at such a slow pace that it's almost flattening out. If it's only growing 1% a year, well, you might want to keep that company if it's a really solid, stable company, but maybe you'd be able to find something that has a little bit faster growth rate over time. Something to consider. I like this slide because I think it puts 5 pieces together that all investors should be thinking about when they are looking to invest. I want to find companies in the upper left that have a history of profit and growth. I want to see them showing strong fundamentals, which in our world would be section 1 and section 2. We want stable earning streams, meaning that we want to see consistently. We don't want a lot of volatility, not a lot of cyclicality. We want them to have a firm commitment to shareholders. That means they're going to share something back with us. And then we want obviously a management team that's convicted, has conviction in this business, that they like what they're doing and that what they want to keep on doing it. My goal is to get a consistent stream of meaningfully increasing dividends over time in this strategy. This is the goal. I said we'd give you some ways to find some ideas out there. Here's 2 of them. One is NOBL and the other one's SMDV. The first one is the S&P 500 Dividend Aristocrats. It's an exchange traded fund. They're looking for companies that have dividend increases for 25 years. SMDV is only looking for 10 consecutive years of dividend growth. And this is for the Russell 2000 Dividend Growers Index. So this is a smaller set of companies out there. The one negative about this ETF.
That's just a lighthouse. I want to do this.
One of the negatives to this is its largest sectors are financials, industrials, and utilities. Maybe not the fastest growing sectors that we want to focus on over time, particularly utilities. The other 2, you can find pretty good growth companies over time. I'm getting a lot of noise and feedback, just FYI. Lastly, what I do is when I get these names, what these ETFs, these are the top 10 holdings. On the left-hand side is the Dividend Aristocrats. Many of these things you've seen these companies over the years. AbbVie is well known, McCormick, the Spice Company, Procter & Gamble, Colgate Palmolive, Lowe's. So a lot of these companies you might name, but here's 10 ideas that if you hadn't thought about, Sherwin-Williams might be depressed right now because of home buildings under pressure. Well, Sherwin-Williams not a bad business. I haven't looked at them in a couple of years, but maybe that's something that could be something that would look better in the future. On the right-hand side is the other particular stock, and that would be SMDV. You're not going to know as many of these companies on this list, but you might recognize Tootsie Roll at the very bottom. There's J&J Snack Food that does churros that if you go to sporting events, most likely you'll be buying a product that they sell. There's other utilities on this list, but there might be something in here, Trinity Industries, the Andersons, that might be interesting to you as an investor. But I go and find these ETFs and go look at them. There's lots of others, these choices. There's Vanguard has a VIG, Victor Indian George, which is their Vanguard Dividend Appreciation Fund ETF. Go look at their top 10 holdings. They also have an international one as well that you could look at. These are places you can go find new ideas to go give you some places to start looking at and saying, well, maybe there's something interesting there. How do I go do it? Well, in this particular case, Noble is the product of a firm called ProShares. If you end up Googling Noble, you'll probably find ProShares attached to it pretty quickly. Just go to ProShares.com. In that particular case, page popped up. I looked for fund fact sheet, clicked on the fund fact sheet. I could see the top 10 holdings. It also tells you how they construct why you want to own this particular group of companies. Again, everything we've talked about so far as well. And they also give you their investment objective. Another place, go to dripinvesting.org. They have a similar concept of dividend champions, like dividend aristocrats. They want to have companies that have paid dividends or grow their dividends they've not only paid, but they've grown those dividends for 25 years or more. So they go look there. They have lists of companies. They also have dividend contenders, companies that have raised the dividends for over 10, but not yet 25. So there could be a lot of choices in there. And then finally, they have some dividend challengers, which is companies that haven't quite gotten to 10 years yet. And in those particular cases, they might become interesting. My alma mater has done some research in this area, and it does seem that there's some efficacy that 9th year. They get some outperformance on there. But go do your own work. Go look at these lists and see if you come up with anything that might become interesting out there for you. And with that, summary is, dividends are real. They show up in your account, hopefully every month. It's a fact. You get the cash. Focus on dividend growing companies. You can have a future growing income stream. As a guy that's now over 60 and liking to get nice cash flows coming to me, I like a growing income stream. It helps me versus inflation over time. And it could be a very good alternative versus fixed income. I think a solid dividend growth stream is quite valuable over time. Probably means more to me today that I'm over 60 than it was when I was 25, but I think it has a long run ahead of them, I suspect, and hence why I like this strategy and the concept quite a bit. With that, that's all I have. And questions, this is my email address. If anyone wants to follow up and shoot me an email, feel free. I'll try to get back to you as quickly as I can. Any questions?
We have a couple. Couple people, while you were talking, kind of Googled the question with regards to companies paying out dividends, and found a couple things that, like for example, with the S&P 500, generally it looks like between 75 and 80% of those companies pay dividends. So that's just an FYI.
Thank you.
A couple other people mentioned a couple of different other ideas, and with regards to the index funds, SCHD, which is one of Schwab's index funds, the US Dividend Equity ETF. And somebody else mentioned REGL, which is a ProShares S&P Midcap 400 Dividend Aristocrat.
I actually like that one quite a bit. Yes.
Okay. And then somebody else mentioned and really likes the Value Line model portfolio as well.
Never looked at that one. And I think I shared VIG and VIGI with you from Vanguard. So,
yep.
and Vanguard really promoted the whole dividend growth concept about 10, 15 years ago after they had some really good numbers. And, I think that really helped push this concept of solid dividend growers over time being not a bad place to invest.
And then with regards to the question with regards to when a company stops paying or increasing a dividend, there was a little confusion on that as far as fitting into the dividend paying model. The question was asked, is it wrong to have two models of investment at a time while you're looking for increased dividends, keeping in mind holding on to stock in solid companies that we believe in? I think you kind of touched on it a little bit with the comments with regards to, outlier with regards to COVID, but I don't know if you wanted to clarify that anymore.
The answer would be you can have as many strategies as you so choose. Personally, I have about 6 different strategies that I use in my different portfolios. The one I use the most is dividend growth, primarily. But yes, I mean, if you were at Better Investing National Conference this year, a couple of us talked about when the market was down 25%. Well, this might not be a bad time stray away from quality and start looking for some things that might not be quality, because they might have nice recoveries piece. I don't think the article has come out yet, but an upcoming article I think will be that I have in Better Investing magazine is talking about that subject. It is in bear markets, some certain sectors that get really depressed can recover fairly quickly, or they have historically. And they might not be bad places for you to hunt for a few dollars in your portfolio, not for your main dollars, but for your speculative dollars in your portfolio. But yeah, you can run multiple strategies. This is one of my core strategies that I have a chunk of my assets and that I'm looking for nice, stable, consistent growth that I don't have to worry about. And I don't worry about this at all, day in or day out. I worry about the companies here and there, but for the most part, I'm pretty confident that this will continue to do what I think it should be doing for a very long time to come.
Yeah, it sounds like this is pretty popular, and I would think would hold up over time in good markets and bad.
That's
just
what
curious,
that's what the history tells us. Yes.
Yep. Just curious, do you have an overall percentage of you were talking about utilizing multiple strategies?
Yes.
Do you use this, you said, for part of your core
Yes.
portfolio, but for the majority, would you say you use it for the majority of your portfolio or portfolios?
No. And I don't, because of my cash flow spending in our lifestyle and where we are from a cash flow perspective. If I didn't need to meet a cash flow need on an annualized basis, it would be probably a majority of my assets. But being that I need to have a certain amount of cash flow coming in to meet our cash outflow, I have a much bigger portion of my assets in very secure assets like bonds and utility stocks, things like that, that will be there in the tough times when you need to have money, when the rest of the market's flat on its back, typically. So
very stable. Yep.
So, but right now I would say it's 25% of my overall asset base, and of my core, it's probably about 40 some odd percent. And I hope over time, as things get paid off, like mortgages and things like that, that my expenses go down and that my cash flow improves, and thus I can have it as being a bigger piece of my overall net worth over time. And I would suspect it would, because it should grow at a faster pace than the safer portfolio in theory.
Okay. Comment was made where you said that you avoid company with high debt ratios.
Mm-hmm.
Would you say there's any sectors such as like rental car companies where you relax that guideline?
No.
Okay.
And the rental car companies are an interesting group. I think they've gone bankrupt every cycle so far. So it's kind of like owning hotel REITs. I think they've blown up every cycle in the last 20 years. So you look like you're getting this great return, but in essence, you really don't get what you think you're going to get. And it's no different than buying mortgage REITs. They almost always end up cutting their dividends at some point, and you don't make anywhere as close to what you think you're going to make. So to me, they're kind of mirage stocks out there. So I am familiar with the auto rental business. I owned some of those companies in the past. I just don't think they're very good business models. They're like airline industries, very competitive, very price sensitive. You got everyone and their dog can do what you do. They're okay for a period of time, but you got to get in, you got to get back out again. That's not how I prefer to invest.
Yep. Again, factoring in the risk factor overall with the industry or the company, again, staying away from debt.
Yeah.
The question came up is are the slides going to be available? And I don't know if you want to take that one, Chris, but I would suspect that we would upload those to the website within a few days.
Yeah, we are going to send everybody actually, we don't have registration here. So we're going to send out a link that has the complete recording. And if Craig wants to give us his slides, we will also make those available on the Better Investing online chapters webpage. If you scroll down, it's about 3/4 of the way down the page. You can see all of our past presentations with the slide downloads as well as the video recording.
You guys are free to share the slides with anybody you want.
Thank you.
Awesome, thanks. All right, at this point, I think I've captured all of the questions that were answered or asked in the chat. Does anybody have any that they want to ask verbally? And while we're waiting, one person, Ken, just made the comment that he assumes you stay away from oil and energy companies because they're cyclically correlated to the commodity price.
Yes and no. So there's something very unique going on in the oil industry in the last 3 years versus what they've done historically. Yes, historically, I've never been a big, huge investor in the oil industry because it's very capital intensive and they don't typically make huge margins. But I've always wanted to have a stake there. Some of that has changed in the last couple of years. Number one, the capital efficiency of these companies has changed. So instead of the past, and I'm not saying they're not going to go back and do this, history will tell me they will because they always have in the last 40 years, but maybe this will be different this time, and those are dangerous words to say. But so far, they've shown very good capital allocation for the last 4 or 5 years, and including, I think the Chevron CEO just came out in the last day or two, said basically that they're looking to use whatever excess free cash flow that comes out to buy back stock and raise dividend. That's a much different story than what they've been willing to tell us in the prior 20 to 40 years, where, you know, if they started getting excess cash flow, they'd start buying properties up and drilling for find new oil. And then the next cycle would go and you'd get hurt again. So I think there's actually a change in the thought process at the top of the two biggest guys, and those are the only two I actually own, would be Exxon and Chevron. I've owned Exxon for a number of years because, you know, if you think about their business models, part of their business counteracts the other side of their business. So their oil exploration business is a business that goes look for oil and wants high oil prices. The other half of the business that counteracts that is refining business. They actually want oil prices to be low for them to make money. They can still make money at higher prices, but they don't make as much. So you know, those two businesses counteract each other, which actually says it should be a reasonably good business model as long as you don't overpay for things over time. Unfortunately, most of these guys over time have overpaid for things that they thought were going to be good growth industries over time. Exxon did that horribly with a company about 5-6 years ago and just way overpaid for a particular company. But I think they've gotten I've seen some charts, statistics recently that says that the last 3 years they've done a better job of thinking about how they spend their money. And maybe the fact that oil prices back, I don't know how or why it happened. It makes no sense to me, but at some point in 2020, we had negative oil prices. I don't really understand how that happens, but theoretically we did. And so maybe that put the fear of God in these companies. It says, you know, you guys have to manage this thing a lot better than how you've done it in the past. So I do own a couple in this particular strategy, but not tons of them. No.
Okay. Thanks. Lots of people are saying thank you and appreciate the information and the seminar. I think we're all caught up on the questions. So at this point, I'm going to turn it over to Serum and take any general questions or comments with the group.
Great. Thanks for your time.
Thank you.
Thank you, Craig. So as Chris mentioned at the top of the presentation, if anybody has any questions, anything related to online chapter or anything related to anything that's investing, feel free to ask us.
Everybody navigating this market and this year, the ups and downs and everything.
pretty exciting. Every time I log into my portfolio, I think I must have made a mistake. Like, oh, I have that much money. It's so different every time.
Do you like realty income?
That sounds like it's a REIT.
Yeah, they pay increasing dividends a lot.
That's
I
not
think
one
that might be a dividend aristocrat. The symbol is O.
Okay.
If you're asking me, the answer, Craig's answer, I don't own them today. I have owned them over the years. I actually knew them when they were privately held through limited partnerships. One of their biggest problems they have is they've gotten to be such a big size that
Right.
that they've had to expand out of what they historically have normally owned and just gotten into other areas of industrial. So they're a little less safer. I think Triple N is a little bit small, is a lot smaller and has that same concept.
What's it called again?
Triple N, NNN.
NNN. Interesting. Haven't heard that one.
It's a number 2 player in that particular space, and there's a third player that's a lot smaller. It's actually, you know, intuitively, it actually kind of makes sense to go for the smaller player than the biggest guys. But I have owned O for a long time. I sold them a couple of years ago, primarily because I think we're overstored in this country, and at the time I thought because of balance sheets they were going to have some real problems. They never did. But that was my concern.
Right. Yeah. Basically,
and
it's triple net lease. So
yeah, it is a triple net. And so the other thing that works against O and Triple N, and in this point, it probably would actually make some sense, because that they're triple net lease businesses. They are, analysts on Wall Street look at them as being very long-term business models, and thus they are treated like almost like long-term bonds. So they should have gone down during this rising interest rate environment. And then if we're at the point here at some point that rates might start going back down again, these could actually do quite well with a falling interest rate. And so I would actually say that's reasonable to suspect out there. And, you know, bottom line, they're good business models. They're decent business models, I would say, at the end of the day, from my perspective.
yeah.
Hey, Craig, after
Mhm.
O and Triple N, what's the third company you said in that?
I'm trying to remember who the third one is. There's a smaller player in the group, and I don't actually remember who it is.
Okay.
But I ran into him at one point, and I go, oh, interesting. I should go back and learn more. Than I probably forgot about him. But I think if you do some searching in the industry, and you'll probably come across a smaller player, and a smaller player just has more flexibility in this world. I think that helps you. I'm not 100% sure.
Mhm. And Kiplinger Personal Finance, this month they came out with their dividend 15, and they made some changes. They got rid of 3M, and you know, they have their 15 stocks that they like. You know, just for information. There's a lot of information out there for dividend paying stocks. It's very nice.
There's lots of. There's amazing how many different places. I mean, literally last night on my Apple phone, I think I downloaded an article about 5 healthcare stocks that looked interesting, and I own 2 of the 5. So I was like, oh, okay, great. But yeah, I like going and seeing in the large funds and see what these large funds own in their top 10 holdings, because
I think they added United. I think they added United Health on the Kiplinger's list.
That's been a fantastic stock for the last year. If you owned it for last year, it's been an amazingly hot stock.
Yeah, a long time. It's really good.
Very good. Any more questions? Any more comments? If none, back to you, Chris.
Thanks, Shriram. thank you everybody for being with us today. This has been a lot of fun. I really appreciate your time, Craig. We learned a lot. Like I was telling the other person, we will have the video available to you. We don't get to be the ones who put it up. So as soon as the people are able to update our website, we will have the video available, and you'll also get the slides if you'd like. And again, it's at the online chapters personal page on the BI website. You just scroll down about 3/4 of the way. You can see all the open forums that we've done. We do these again the third Wednesday of
If
every
you were
odd
listening,
month. So the next one will be in January. Everyone, please have a fantastic Thanksgiving and a wonderful holiday season. And we'll look forward to seeing you in January. And if you have suggestions for us for what you might like to see in a future workshop, please send them off to us, because we love to, we're here to please you.
Thank you and bye-bye, everyone.
Awesome. Happy holidays.
Happy
Bye-bye.
Everybody.
I think people are mostly moving on. Craig, are you still there?
I am. Do you need me to stay, or do you want me to go and you guys can chat among
Well,
yourselves?
I just wanted to say that we had about 65 people tonight, which I think is a record for us. It was certainly for our system. It was a very, very good turnout. And
Mhm.
I thought, it really was a nice presentation. So we said formally that we appreciate it, but I just wanted to add my 2 cents.
I appreciate that. Thank you. No, that's a lot of people. That's good. Congratulations
Yep.
on getting big numbers. That's good to hear.
Well, I think you got them for us, Greg. Thank you.
Yeah.
It's your event. I just show up. That's all. That's all I do.
Yeah.
So, but thank you for inviting me to this. I wasn't even aware that you guys were around doing this. So this is all good.
It's
Happy
fairly
to
new.
learn.
This is really we're still in our first official year, right? Doing this. So.
We looked for a niche, Craig. There's so many national presentations at this point. And so we were a little apprehensive of just doing a national presentation. So we thought that something that would be a little more interactive. What we have actually found, I think, is originally we were just going to do forums, and let people ask questions. But what we've really found is that having a presentation, it's maybe not as long as a standard webinar, and then time for question and answers, and finally some time for whatever people want to talk about, has been a pretty good model for us.
Yeah, we've wondered in San Francisco about trying to do just a question and answer kind of event to get people to log in once a month and ask their questions. And I've always wondered whether you really get a very good response, because I find many people want to go and hear what other people's questions are, but they don't actually want to ask the questions themselves. And so I just don't know
We
how
found
well
that there has to be a little bit of an icebreaker. Right? It's
Little-
silent, and then one person asks a question, then all of a sudden there's 10 questions.
Yes, but you need to kind of prime the pump, or whatever you call it, to get people to ask the questions. Otherwise, everyone just kind of waits. So okay.
Well, you can use plants. We've done that in the past.
Oh yeah, I've done that too. I will do that in my presentations. Well, sometimes I get asked the following question, and all the time. So yeah, but anyways, okay. Thanks for having me here. This was good.
Thank you.
Thought it went well.
Thanks very
Great.
much.
I'm gonna jump off if that's okay, unless you need anything more from me.
No,
And
no,
I'm
just
gonna
Is it the same version of the slides that you had emailed earlier, or did you make changes?
Whatever I sent you is what I presented tonight.
Perfect. Okay, great.
So
We'll
there's
put
no
them on the
changes.
website.
If you guys want to put in PDFs or something, that's fine. I don't really
Awesome.
Great.
do whatever you want.
Appreciate
Will
it.
do.
Sure.
We
Take care, guys. Thanks.
appreciate that.
Thanks so much.
Yep.
Happy to
Thanks,
help
Craig.
out. Okay.
Yep.
Thanks
Take
very
care.
much.
Okay. Bye-bye.
Bye-bye.
All right, so for the education committee, are we good, or do you guys want to plan a meeting next month or not?
I think if we're going to have a speaker for January, then I guess the question is, are we going to have a speaker for January? And if we're not, then we have to meet and talk about it. But if we are, then we do what we did this time.
Does anybody have an idea for a good speaker for January? I don't know, but I think that we're attracting more people if we do have some kind of a presentation.
Absolutely. Let me just look back to what the topic was meant to be for the next meeting. And maybe we can think of some suggestions. I just have so much email. It's so hard to find things.
What we talked about, Chris, was to have some sort of a theme.
Yeah, but we did it. We actually came up with, remember when we met, we came up with topics for each month.
Last month, I think, yeah.
Yeah, and I have them somewhere, but they're in my email, and there's just so many emails.
I think
Did anyone save my email?
I probably have your emails, Chris.
Same here.
I know I have it, but gosh only knows where the heck it is. Oh, here, topics for coming in. Okay, here it is. Common or preferred stock. That's our January topic.
Oh, okay. Well, that's a good question.
Do you have someone in mind, Dan, for that topic? I thought someone had somebody in mind that could talk about that.
You know, I guess the question would be, is there somebody who has talked to Bink who talks about that?
Well, let's do that then. Let's search through the last couple of banks and see if we can find someone who has talked about that, and then we can just have a quick meeting in January, hopefully with a plan, and find a person. And in the meantime, if anybody finds someone, please send it to the group. And
Sounds
that
good.
will, yeah, great. Yeah, what next month our meeting will be, what is it, like probably Christmas Day or something, right? Let me just see what the date
No,
is.
it would be before Christmas Day.
So it will
Third
be
Wednesday be the 21st. So it's gonna be
21st,
pretty
yeah.
close.
Pretty close. Do you want to meet a different day in December or a different Wednesday? The 14th, is that better?
That works.
That work for you, Dan?
Yeah, the 14th, yes, it would, I think. Hold on, let me see. My calendar has gotten more complicated than I would like.
I have that. I have
The
a lot of
14th,
technology that's
the
smarter than I am.
14th is fine for me.
Okay, great.
I think Serum left, so I'm gonna
Yeah.
email that out just so he knows, but that should work.
Okay, great. I'll send out a Zoom invitation.
Awesome.
Okay, great. Thanks, everyone. Nice
All right, well,
job.
happy
Great.
Thanksgiving.
Yeah,
Happy Thanksgiving.
I didn't want to interrupt you guys, but I just want to say great
Right.
job tonight.
Thanks,
You did a
Avi.
great job. All right.
Thank you.
Have a good evening, everybody.
Thanks, you too.
Thanks,
Happy
you too.
Thanksgiving.
Avi, do you
Take
know
care.
anybody, Avi? Do you know anybody who talks about preferred stocks?
I don't. I also don't know how solid a topic it is. How much you can really, how much this really is to talk about. So it probably would be a very short presentation, but I'm sure there's a bunch of people out there who'd be willing to talk about it. It's really not something I've heard talked about very much in this organization, probably because there isn't all that much on it, but I'm sure somebody would be willing. You might want to ask somebody like Doug Gerlach. He might be willing to do, able and willing to do that. I'm trying to think who else. Doug is the one who comes to mind, but I'm sure there are others out there. I just can't think of anybody right now.
Right, well, we'll talk to Doug. Thanks, Avi, and see if he can, take that as like a guideline and then make an interesting presentation out of it.
I just realized the recording's still going, so you may want to stop
Oh.
that.
We can trim it.
Yeah.